I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up, we are watching two big events. One, that deep freeze that continues in Texas, causing crippling power problems for millions of people across the state. Plus, prepared testimony ahead of Thursday's GameStop hearing. Just what will Robinhood CEO Vlad Tenev tell lawmakers? And legitimizing crypto, MasterCard has announced it'll start facilitating cryptocurrency transactions this year. We're going to speak to CEO Michael Miebach in a wide-ranging conversation. And Shopify beats. The e-commerce giant exceeds estimates in the fourth quarter, but shares dropping on the possibility of slowing growth later this year. We're going to check in with Shopify President Harley Fingerstein about the forecast for online shopping. All of those stories in a moment, but first, a mixed day for U.S. markets as the Texas energy crisis continues. Our Ed Ludlow has the picture from San Francisco. Ed, walk us through the day.
Yes, the S&P 500, the main gauge of U.S. equities, was basically flat. But what's interesting is that 8 out of the 11 industry groups on that index ended Wednesday in positive territory, in the green. It was really technology stocks that kind of pulled the rest of the index down. You can see there the NASDAQ 100 lower by 0.5%. The NYSE FANG Plus index, that basket of mega cap tech stocks, down by 1.48%. But here's my stat of the day, stat of the week, Emily. It was the first decline in 11 days for the NYSE FANG Plus index. That was its longest streak of wins since the index was founded in 2014. Investors taking a pause on big tech after what was an incredible earnings season where we saw those bigger cap tech stocks have outsized earnings growth relative to the rest of the market. And you can see finally the Philadelphia Semiconductor Index also lower by 1.9%. The other side of the coin today in the market, of course, is the Texas energy crisis. And you can see one of the big outperformers on the S&P 500 were energy stocks, rising as we saw oil in New York, WTI, and natural gas make significant gains. The idea here, of course, is that while all of these oil producers in the Permian Basin and natural gas suppliers are unable to operate, that removes supply from the market while there's incredible demand because of the low temperatures that we're seeing. That's boosting the stocks of those that are producers of that. But the other direct effect of the Texas freeze has been semiconductors, Emily, because we've seen a number of big names in Austin, Texas in particular, have to idle plants. NXP Semiconductors, one of the biggest suppliers to the automotive industry, has idled 2 plants in Austin. Infineon, a German chip maker that has a plant in Austin, has also shut one down. And that's had some permutations throughout the semiconductor industry. You can see other names like NVIDIA, Broadcom also down. NVIDIA, the biggest points decliner on the Philadelphia Semiconductor Index on Wednesday. So investors taking a lot into account. We also got economic data that showed strength in the US consumer, but also rising prices. And that's given some concerns around inflation. We also see Treasury yields higher. And in an environment where there are inflation concerns and an environment where we see yields higher, that often weighs on big tech. And that was certainly the story on Wednesday. Emily.
All right, Ed, thanks so much for that roundup. Continuing to follow this power crisis now, the outages caused by icy weather impacting millions of people across Texas and the central United States getting worse, with some blackouts expected to continue through at least Thursday. Texas's grid operator cut power to 2.8 million homes Wednesday morning, just hours after restoring service to 700,000 households. Energy analysts and experts say the crisis underscores the U.S. electric system's need for additional power lines across the country and large-scale storage systems that potentially could give a rhetorical boost to President Biden's plans for a historic investment in our country's electric grid. Joining us now to discuss, Bloomberg BNEF's analyst Nick Steckler. Nick, what is your assessment of what is still going wrong here?
To start with an update, things are very dire in Texas right now, and Texans are still in the thick of it. This is going to go down as one of the biggest power shortfalls in history in the U.S. power sector. To start with what the real primary cause is of all of this, the grid operator in Texas is called ERCOT. And every quarter, every year, they're looking out ahead and trying to figure out what demand is going to be on each season. And typically, Texas is a summer peaking system, and winter is usually a pretty relaxed time of year. Well, Texas got hit with summer level demand in the middle of winter and blindsided all of the power capacity that really should have been ready. What happened was ERCOT ended up under forecasting the demand by 25%. And so that's how we got here. And there's a lot of news about different outages as well of different types of power generation capacity. I think that comes second, because the first issue is there wasn't enough guidance to direct the power capacity to be available because of the under forecast. And then when we look at what capacity was available, there were outages across all generation technologies. So we saw coal, nuclear, natural gas, and wind all have really big issues with the freezing and the cold weather shutting these plants and turning them offline. And so that's how we ended up in a situation where 40% of the Texas fleet is offline and millions of people are without power.
Now, the state has just banned natural gas companies from taking fuel out of the state. I want to talk about restoration. Just as I was sitting down, one of my friends in Texas said their power had just come back on, but I know some folks have had power restored and then it's gone out again. What is the timeline for getting power back to everyone?
They're right in the middle of it. It's going to be cold for the rest of this week, and one of the biggest issues we've identified is that natural gas-fired power plants cannot get the gas that they need. There's been other issues with icing as well, and so as things start to warm up, hopefully by Friday, plants will be able to get back online faster. Once those plants are able to be online, let's say at the earliest we get most of the generation capacity back online in a couple of days at the very earliest, then customers need to be reconnected in mass, so turning on different neighborhoods, and that doesn't just happen all at once. With this size of a shortfall, it's going to take days to really bring all the neighborhoods back online, all the cities, all these different parts of Texas that have been shut down. If we look back at 2011 to compare to their last blackout like this, which was much smaller, much smaller, the rate, if we transfer it to today and try to figure out how long it would take to get everyone online, in the most optimistic scenario, it would take much more than a day if they had to go at the rate that they reconnected people last time. So put that all together, in the most optimistic scenario, maybe by the weekend there could be full connectivity and supply, but it really doesn't look like that. If we talk to our natural gas team, who's looking at the pipeline networks and the freezing problems there, which is the number one issue, that's going to put us well into next week before really everyone has power.
Wow, that is a long time to go without power and potentially even water. Some folks haven't had water now for more than 24 hours. What does this mean for the power mix given Biden's plan and given the tug of war that continues to happen between the supporters of renewable energy and folks who are saying it's the intermittent problems with renewable energy that created this problem?
We can think about responses and technology needs maybe in terms of the short term and the long term, and I see the Biden plan as more of a long-term thing. In terms of federal response, though, in the short term, we could definitely see incentives for transmission and power grid hardening. The resiliency of the power network is going to be a big priority, but really it's more about, in Texas, what might the response be in the short term. We could definitely see oil be dispatched to gas plants that can burn it, so we might see investment in gas plants in the near term to be able to get them to burn oil on site to prevent this type of thing from happening again in the future. We could definitely see weatherization of all different types of power plants to be able to deal with the cold. There's technologies that are proven in colder climates that Texas never thought it was going to need. And then, of course, from the grid operator's perspective, they're going to have to expect to have more capacity online in the winter. But to come back to your question really quickly about the Biden clean energy agenda, if we look at 2035, getting to that goal that they have set of 100% clean energy, it's really going to be about replacing natural gas. And in this situation, what these blackouts show is really a hit on natural gas's traditionally reliable, perception of being the backup fuel. So freeze-offs on the pipeline and production network for natural gas, and gas being the largest and also most hit generation source here in this situation, is maybe going to open up opportunities for new technologies, possibly small nuclear, hydrogen, storage, of course, which is already seeing a lot of acceleration since the California summer blackouts last year. I think it's a good opportunity for new technologies to come in and get a win over natural gas.
Okay, appreciate the roundup there. Bloomberg NEF's Nick Steckler, who covers energy for us. Thank you so much for that update. Meantime, coming up, we are looking ahead to the House GameStop hearings happening Thursday. Is more financial regulation ahead? That is next. This is Bloomberg. All eyes in the trading world will turn to Washington Thursday as the GameStop House hearings get underway. Testimony includes that of CEO of Robinhood, Vlad Tenev, and the CEO of Citadel, Ken Griffin. At the core of the conversations, the practice of payment for order flow. It's a practice that's come under new scrutiny in the wake of the GameStop frenzy and the boom in day trading. Bloomberg's Shonali Bostic explains why transactions between retail brokerages and large high-frequency trading firms have raised eyebrows in the financial world.
Day traders are piling into the stock market, and major Wall Street firms are paying lots of money to handle their trades. It's outraged some who feel that the relationship to Wall Street is a bit too close. It's called payment for order flow, sometimes PFOF for short, and it's a key pillar of zero-fee trading. A brokerage, like E-Trade or Robinhood, will direct orders to a market maker, like Citadel Securities or Virtu Financial. In return, those market makers will pay the brokerage a small fee. Those firms are making money on bid-ask spreads for stocks and options, and the SEC has traditionally accepted PFOF as a way to transfer some of the market-making profits to the brokerages. It helps the market maker, in return, amass greater volumes of trades, ultimately bringing them more money. The PFOF fees add up. They reached about $3 billion across the industry in 2020. The Schwab organization, Robinhood, and E-Trade brought in the most fees, with Schwab and TD collectively taking in $1.4 billion. Citadel Securities, which handles more than a fifth of U.S. equity volumes, has paid more than $1 billion for order flows last year. Some of these market makers are high-frequency traders who handle orders in fractions of a second. Their involvement theoretically benefits customers. Bloomberg intelligence analyst Larry Tabb calculates that it saved retail traders $3.7 billion last year. Yet the practice has drawn a lot of criticism. Senator Elizabeth Warren says there are troubling concerns about Robinhood's relationship to Wall Street and has called for a clearer accounting of the relationships between the counterparties. Still, payment for order flow has made it much easier to provide services to new day traders and expand access to stock markets. It may be here to stay, but it's likely to stay under scrutiny.
Bloomberg Shonali Bostic there with more on the upcoming hearing and payment for order flow. I'm joined now by Duke Law Professor Gina Gale Fletcher. Gina Gale, thank you so much for joining us. So do you see a problem with payment for order flow?
Yeah, so payment for order flow is, I think, a troubling aspect of the markets that has definitely allowed platforms like Robinhood and E-Trade to grow significantly by attracting retail investors with this promise that there is no cost to their trades. However, as you know, we always say, there's no such thing as a free lunch. And so this is being paid for in some way by the retail traders, these day traders. They're paying for this, for these transactions in some way. And there is some question as to whether or not they're fully aware of the extent to which they are bearing the costs for this supposedly free service. And that's what payment for order flow hides from the retail investor.
So I believe Robinhood would say, we disclose this to our customers, we disclose this many times during the process. Is that not enough?
So there is some disclosure going on there for sure. This is something that the SEC is requiring of these brokerages to do. They have to disclose, their arrangements for this, for payment for order flow. But to some extent, this isn't enough because a lot of investors, I believe, don't truly understand the level or the cost that they are bearing because Robinhood is able to kind of aggregate this, right? They're able to aggregate their disclosures without really disclosing to a retail investor what they lost by having their order flow routed to a specific market maker who then, pays a cut to Robinhood and the cost or the price that the retail investor is able to execute their transaction at may not be the best price that is truly available within the market. And so I don't think this technicality of it all is really at the forefront of retail investors' mind, even or notwithstanding the disclosures Robinhood might be making.
Now, we did just get the prepared remarks of Vlad Tenev, the CEO of Robinhood, who will be testifying tomorrow. He says, I want to be clear at the outset, any allegation that Robinhood acted to help hedge funds or other special interests to the detriment of our customers is absolutely false and market distorting rhetoric. Our customers are our top priority. From what you've seen, do you believe that there is anything wrong with Robinhood's model? Anything that regulators could fairly challenge?
So I think that with Robinhood's model, there are some things that might raise some concern. One of the things is that Robinhood, by default, they place traders into margin accounts, allowing certain retail investors to trade with borrowed money, to trade on leverage, which magnifies potential wins, but it also magnifies potential losses. I think that there needs to be a deep consideration of whether or not we want everyday traders to be defaulted into these types of margin accounts in which they're able to trade on leverage, especially to some of the extents that we've been able, that anecdotally we've heard that traders are able to do. And so while Robinhood might tout itself, and Robinhood and others, I should say, might tout themselves as bringing this supposed democratization of the market, we have to think about whether or not there are hidden costs to this retail participation in the market that the retail investors might not be aware of. And that, again, comes from that payment for order flow, as we talked about earlier, but it also comes from this access to fairly complex financial products and financial instruments that are now available at the tip of the finger of certain retail investors who may not understand the complexities of the product or the prices or the true price or valuation of these products.
I also want to talk to you about the potential burden on the individual retail investors who got involved here and the folks who were rallying the troops. Keith Gill, known as Roaring Kitty, who has a very popular YouTube channel where he talked in great detail about what he saw as the financial performance and financial future of GameStop, has been sued on behalf of one of the individuals who lost money. Do you see any culpability there? Is he really liable for something?
Given what I know so far about this situation, it would be hard for me to say that he is liable. And there are a few points here. And again, if there are other facts that come out later to change the situation, then I would have to revise what I have to say. But based on what we know so far, he put out his opinion about what was going on, what he thought was the future of GameStop, and what he thought was the future of the company's value. And without having spread materially false information, making some misstatements of fact, in some way, this doesn't seem to rise to the level of the type of fraud that we're normally going after if he was doing potentially a pump and dump scheme to manipulate the price of the stock upwards. Now, there is a requirement that he disclose any interest he might have in the company if he's being paid for touting the stock. And it doesn't seem as though this is what is going on here. So simply suing him because he simply put out his opinion and you decided to follow it may not actually be a solid basis for liability. And so I'm not sure that there's anything there other than probably sour grapes.
So look then, as you look across the very many competing issues and parties here, do you see anyone who bears blame or liability for the problems that and sued? And do you think that there actually be new regulation as a result of this investigation?
Sure. So I think this investigation, like many investigations going into potentially artificial or inflated prices, is going to be a long one for the SEC, right? They're going to have to be going through thousands, if not millions of trades, probably millions of trades in order to kind of nail down what went on, by whom, who bought what, who sold what, and what was going on there and what their interests were. When it comes to blame, this is a really tricky question because from a morality standpoint, we want to be able to blame someone for what happened, but it depends on what we're trying to ascribe blame for. So one could say that we could blame the short sellers who created the conditions that made this short squeeze possible, but others might say we could blame the SEC for even allowing this level of short selling to be possible and legal in the first place. Or we could say, are we trying to blame the traders who took advantage of the potential for a short squeeze? The blame scenario here, I'm not sure that will get us very far, because what happened in the markets is that there was a sort of irrational exuberance that was going along with some kind of a social movement that caused GameStop's stock to rise to artificial levels. And to me, what really is concerning is that the SEC did not intervene in some way earlier to kind of either stop trading on these stocks earlier, thereby leaving it up to Robinhood and other brokerages to make that decision piecemeal, and that there wasn't some kind of overarching goal that was vision that was released by the SEC or the exchanges.
Well, it is certainly going to be a fascinating day. We're going to be tuned in. Gina Gill Fletcher of Duke University, thank you so much for sharing your analysis with us. Coming up, YouTube joining the short video trend to be the latest platform to try to take on TikTok. We'll have all the details next. This is Bloomberg. Some other tech stories we're following today. YouTube is taking on TikTok by introducing a short-form video feature called Shorts to the United States in March. Shorts will let users create and upload 15-second videos, which is the length of an average video on TikTok. YouTube has been testing the feature in India since September. The Dogecoin market has a leader of the pack. Records show that one person or entity owns about 28% of all the cryptocurrency in circulation, about $2.1 billion at current prices. Dogecoin was created in 2013 as a satirical homage to Bitcoin. This year, the price has climbed to 5 cents each. Coming up, I'm going to be speaking with the new CEO at MasterCard, Michael Miebach. We'll be talking crypto and much, much more. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. MasterCard is launching the first card that will support the world's first central bank digital currency. This after announcing it'll start facilitating crypto transactions later this year, helping to send Bitcoin to new highs. MasterCard also throwing its weight behind new efforts to support Black-owned businesses hit hard by the pandemic. To cover all of this, I'm joined now by MasterCard CEO Michael Miebach. Michael, thank you so much for joining us. I'm anxious to get your thoughts on cryptocurrency, but first I want to start with the big picture because you have such a unique view into the health of consumers and spending trends. What trends are you seeing in consumer spend, and what does that tell you about what's to come later this year as we come into a new normal?
Hey, Emily, good to talk to you. That's a fantastic question and one that we're being asked all the time. As you can appreciate, going through 12 months of COVID, there's governments, there's businesses, there's bankers, everybody really wants to understand how the pandemic has hit the economy, how has it hit their business, what it means for consumer expectations, and so forth. So it's a question that we invested a lot in. We have all sorts of data, as you can appreciate. I would describe our business as a bit of a seismograph on what's going on around the world. what I'm seeing in terms of the trend is you look pre-pandemic, we're all engaged in e-commerce. None of that was new, but what we see during the pandemic is really a seismic shift in terms of consumer behaviors, because you had to shop online. So the rise of e-commerce has just dramatically accelerated. I think years of change have been compressed into the last 12 months. That's the first thing to say. But then you ask the question, what of that will really translate into muscle memory? What of that will stay? What makes a trend? So in order to get underneath that, we've done regular consumer research around the world and trying to augment our data pieces with what consumers are thinking as they look ahead. And here's what we've heard is, 2/3 of people asked in like 14 markets around the world is, I want to do more digital banking. I want to do more online payments because I learned to like it. And I want to use less cash. So that is the fundamental trend that's at work here. And the question then is, will that stick? What will happen? Is there a reversion to previous behaviors? And here, I'm convinced that once vaccines are rolled out, once travel restrictions are, taken back, people will want to get out. They want to make up on lost time. You want to go and travel and see friends and family. You want to go back to this sports event. I think, the NFL Super Bowl just recently probably triggered exactly that desire. So, the way we look at the future is those good experiences that people learned about because they had to in terms of easy online checkout will stay. But reverting back to eating in your local restaurant, supporting your local shop, taking a trip, that's going to come back. I believe there's significant pent-up demand out there. We're ready to enable both in-store, online, whatever it is.
How important is the return of travel to MasterCard's growth?
Travel is a very important aspect of a business. We enable travel domestically, internationally. When you currently look at our card not present, i.e. the online spend, a significant portion of that is people booking trips on booking platforms, etc. But then there's, of course, the physical travel as well. So it's a significant driver of our revenue. It matters. We focused. We have a differentiated position there. We gained a leading position when it comes to travel card portfolios. Everybody knows co-brands. We are positioned very strong, and we continue to bet on the return of travel, not only because it matters, but it also matters to people.
Now, I got to ask you about the crypto news, and I want to start with the sand dollar. You're rolling out prepaid cards that can be loaded with the world's first central bank digital currency, the sand dollar of the Bahamas. You will be the only card that supports this. How much volume are you expecting here, or is this more of an experiment?
So the Bahamian government and the central bank there, they launched a central bank digital currency last year. It launched in October. And what is happening now is this is one of the first central bank digital currencies that are live out there. And we're basically providing an ability for a person, a business, anybody in the Bahamas that is owning that digital currency to transfer it into fiat, the real Bahamian dollar, i.e. the physical Bahamian dollars, and start to use it on a MasterCard. That is nothing different than from various other such card programs that we have where other cryptocurrencies can be transferred into MasterCard to be used in the shop to buy a coffee, a pizza, whatever you want to buy with it. So it's not an experiment, it's real. What really is the distinction here, this is the first central bank digital currency that we will transferring into fiat currency versus all other programs that we currently have are actually private sector issued cryptocurrencies.
So what other central banks are you talking to?
There's a whole range around the world that we're engaging with. There was a group of central banks just recently putting out a paper on how central bank digital currency should work. Two-tier concept, making sure that there's a lender of last resort, and commercial banks are coming into the fold to making sure that you can actually effectively distribute this currency. So the leading 7 central banks around the world put together in partnership, or with our input rather, a statement on how that should be constructed. So at a given point in time, we have 10, 15 programs in different countries around the world supporting the implementation of such central bank digital currencies, including providing a test facility. So we launched a sandbox where governments can come in and invite banks to test how this will actually work. Because in the end, to bring a utility to consumers, you got to see what does the last mile do? How can I spend in a shop? And that's where we come in. And it was a big announcement that we made at our earnings call 3 weeks ago, where we said, okay, we will actually enable those central bank digital currencies in our network, just like fiat currency.
Now, you've also said you're going to start directly supporting some cryptocurrencies for use in payments later this year. Which cryptocurrencies are we talking about, and are we talking about Bitcoin?
Yes. So, Emily, that's an important question. Central bank digital currencies, the nature of that is they're essentially stable coins. They're backed by the country. There's private sector stable coins as well. They're backed by generally deposits. They're logged at commercial banks. That's a type of cryptocurrency that we believe in will bring utility from a payment perspective. We've not made any decision yet which one of those will be, but that category, private sector issued stable coins, is one that we believe will work. We put out principles to decide which ones in the end we will support and which ones not. And the first principle, of course, has to be regulatory compliance. There's this principle on consumer protection, like data privacy, for example. You want to make sure that what comes along with your crypto payment is really the data that only you understand to want to pass along. And then finally, there's an aspect of stability. And stability is guaranteed in the end through the concept of a stable coin, because it's backed by an asset. And here's where you come to non-asset backed cryptocurrencies. And you're talking Bitcoin, you talk a range of others. And right now, the lack of stability, fluctuation of prices make them not usable from a payment perspective. So here, there's a problem. Imagine you buy a pizza, and the pizza costs 10 units of a free-floating cryptocurrency, and the price within minutes fluctuates significantly up or down. Your pizza could have been worth $40 or $5. From a payment perspective, that is a problem. From an asset class perspective, that's not a problem. But we're not an investment company. We're the payment company, and we're guaranteeing a payment from a buyer to a supplier. So that is the issue there. What we're doing, therefore, is coming right back to the sand dollar and Bahamas, is we're enabling Bitcoin asset holders to say, you transfer at an exchange at one of our partner programs that can you spend through our network.
So I just want to dig a little bit there on Bitcoin, because obviously your news about being more accepting of cryptocurrencies sometime later this year helped to send Bitcoin, the price of Bitcoin, up. We just spoke with Nouriel Roubini, well-known economist, who says it is pure speculative, self-fulfilling bubble. This is a pure speculative, self-fulfilling bubble. It doesn't have any income. What is your reaction to that, given what you just had to say about stability?
Yeah, Emily, my view is, I look at this question through the lens of a payment technology company. As I just laid out, it really doesn't bring much utility from a payment perspective because of the fluctuations. From an investment and asset perspective, we're not an asset manager. I mean, that is people taking risk, and they're looking at this as any other asset class. And, that is something that we really don't take much of a view on. I think it's important for us to say, if people have invested and they want to transfer that into a network to buy something, buy a house with it, that we enable that. Because in the end, we enable choice in payments. We don't really stand for cards. It could be real-time payments, it could be crypto, it could be anything for that matter. So that's our approach to this.
Now, I want to talk a little bit about some of your other priorities, because financial inclusion is one of them. You've got a new partnership with Jennifer Hudson. You've also got a new initiative to support Black-owned businesses and other small businesses. And I'm curious what trends you're seeing there among Black-owned businesses, let's say over the last year. Did they struggle more than other small businesses?
Emily, it's a fantastic question. You're putting a finger right on the problem, and I think what we've seen a dual crisis here. There's the public health crisis. But there's also a crisis of, exclusion of hitting minorities a lot harder than other parts of the population, and that played out in many markets around the world. So we clearly can say that small businesses are hit harder than larger businesses, no surprise, because their financial resiliency is of a different nature. And then you look at minority-owned small businesses, you see that even more pronounced. Black-owned businesses in the United States have been struggling significantly. It now has to be everybody's interest to make sure that they can stand up back on their feet and get back going. And here, in terms of the equal opportunity that needs to be created to ensure access to capital, to ensure that you can get your business online if you didn't have an online presence before, all of that is what we're trying to enable. We put a commitment out there of $500 million altogether to support the Black American community. A good chunk of that will go for small businesses. And, a partnership with Jennifer Hudson should help to really, draw attention to the topic, draw in partners, because we can't do this ourselves. As a network, we have a lot of partnerships out there, and we want more partnerships to come on board. So it's a very important topic here in the US, but it's one around the world. In terms of SME support, generally speaking, look at emerging markets anywhere. It's the backbone of the economy. We put $250 million out there and say we want to get small business and help them go online and survive in this new digital economy and ideally thrive.
All right. Well, fascinating to hear you on such a wide range of topics, Michael. Michael Miebach, CEO of MasterCard. Obviously, the company has evolved so much more than a credit card company these days. Okay. Coming up, Shopify's fourth quarter sales soaring past estimates, but the e-commerce company expecting to see slowing growth later this year. We're going to break it all down with the president of Shopify next. This is Bloomberg. After a meteoric rise in 2020 that made it Canada's most valuable company, Shopify has a lot to live up to. Revenue in the fourth quarter was $978 million, beating forecasts propelled by a boom in online shopping amidst the pandemic. But the company is anticipating a slower pace of growth, partly due to a resurgence of brick and mortar stores as more vaccines roll out. Shares declined after earnings. Joining us now to discuss, Shopify President Harley Fingerstein. Harley, talk to us about what you see in the second half of the year as we move into a new normal. We just heard the CEO of MasterCard talking about what's happening with small businesses. And to be fair, they benefit on either end, whether you're buying online or you're buying in person.
Look, I think there's a lot to be optimistic about, even in the second half of 2021. I think, last time I was on your show, I mentioned that it feels like the retail world that would have existed in 2030 was pulled back to 2020. So we certainly have seen this massive catalyst to an acceleration in digitalization in commerce and retail. But actually, you heard this in our earnings this morning, but we are writing the future of commerce, and entrepreneurs are really the heroes of our story, the heroes of the Shopify story. We talked about that we are arming the rebels, the entrepreneurs, the small business owners, the independent brands, and the rebels are winning, and consumers have been voting with their wallets for the last 10 months or so to buy from independent brands wherever possible. In 2020, 47 million consumers purchased from a Shopify merchant. That's up 52% from 2019. And our merchants' performance helped expand Shopify's lead on an aggregated basis to be the second largest e-commerce retailer in the US. Shopify is now about 9% of all US e-com. Now, if you think about it, Shopify is a proxy for independent retail, for direct-to-consumer retail, and we only succeed when our merchants do. And this has led to what I said this morning on the call. We now have more than 1.7 million merchants on Shopify. people from first-time entrepreneurs making their first sale every 28 seconds to the likes of O'Neill and Hallmark and Herman Miller and Purina and Diageo, who also just launched on Shopify in Q4 alone, and revenue nearly doubled year over year to $978 million, as you mentioned. And GMV was above $40 billion, which is up 99% year over year. So there's a lot to be optimistic about. And actually, the future of retail and commerce, we think, is going to look a lot more like these independent brands than these sort of department stores that existed in the past.
So, it's interesting. You announced last week that Shop Pay is going to be available off Shopify for the first time, powering transactions off Facebook and Instagram. How much growth are you seeing there?
Well, that's sort of a new thing for us. So we announced it last week. Shop Pay, of course, is our accelerated checkout. We know that it not only helps merchants get more sales, it helps buyers convert better, much faster. And now we think that providing it to the Instagram and Facebook platforms means that our merchants can not only access new customers on those platforms and frankly anywhere where customers are, but now can transact in a more efficient way. But I think what you're seeing, if you zoom out for a second, is Shopify is becoming far more than an e-commerce provider. We are trying to build the world's first retail operating system, which makes it as easy as possible, where the cost of failure is as low as possible, so more people can participate in entrepreneurship. But we think the future of retail is not online or offline or anywhere in particular. It's wherever consumers are. And so that's what we're trying to build. And seeing Shop Pay move into Facebook and Instagram is a really great way to demonstrate where the future of retail is happening.
So quickly on the subject of participation, Elon Musk recently tweeted about Shopify saying it was great. SpaceX uses it. That sent the stock up. It sort of, reminds me of this GameStop hearing, which we're going into, where you're seeing a shift in power from institutions to individual investors. And I'm wondering, as the president of a public company, what your view on this is.
Look, I think more people participating in the equity markets and participating in buying companies that they think are valuable is a wonderful thing. But just in terms of how we run our business, we're not monitoring the stock price day to day. We are trying to get to a point where we completely democratize entrepreneurship. And so we use a 100-year perspective. We want to build a 100-year company. We're about 15 years into our journey right now. We have 85 years left to go. And so in the long run, we're happy where Shopify is. But frankly, on the topic of more participation in the equity markets, we think that is also entrepreneurial. We think that's also democratizing. So I think if you do it prudently and you do it carefully and you know what your, caveat emptor, buyer beware, I think there is a way for this to be a positive story long term.
Okay. All right. Harley Fingerstein, president of Shopify. Thanks so much for stopping by. Good to have you. Coming up, expectations have been sky high for Apple on suggestions of a new iPhone super cycle, but much more to look forward to in 2021. A sneak peek at our Power Up series next. This is Bloomberg.
I'm Mark Gurman, and on this week's episode of Power Up, I'll be taking a look at what to expect from Apple this year and in the years to come. If you're an Apple user, there's a lot to look forward to in 2021. First, let's talk about the iPad. The company is planning to announce a new iPad Pro in the coming months that looks similar to the current models, but adds a new mini LED screen to the larger version. That will make the tablet ever so slightly thicker, but the improvements will mean a brighter screen and far better contrast ratios. You can also expect a new processor that's on par with the M1 chip in the latest Macs, 5G, and of course, better cameras. You can also look forward to a thinner entry-level iPad later in 2021. On to the Mac. The company is planning major new versions of the MacBook Pro, MacBook Air, iMac, and Mac Pro, all with in-house Apple Silicon chips. You can expect the new MacBook Pros to launch around the middle of the year. They'll have minor design changes, but also remove the controversial Touch Bar, bring back the magnetic MagSafe charger, and to the joy of YouTubers and photographers alike, also mark the return of the SD card slot. The MacBook Air will see a significant redesign, going much thinner as early as the end of this year. That laptop will also bring back the MagSafe charger. The iMacs will see their first full redesigns in nearly a decade toward the end of this year, gaining a design similar to the $5,000 Pro Display XDR. There's also a new Mac Pro in the works that's about half the size of the current model, leveraging Apple's more power-efficient chips. You can also, though, expect an updated Intel Mac Pro for users who need true Intel compatibility. Of course, everyone wants to know about the new iPhones. Expect a lineup in the fall that looks similar to the iPhone 12, with the possibility of an in-screen fingerprint sensor as the major new feature, in addition to better cameras and faster chips. One should expect new Apple Watches to launch around that time too. Further out in the pipeline, likely in 2022, is a mixed reality VR and AR headset that's pricey and focuses on gaming and communications. Much further out will be a pair of AR glasses that can overlay information like texts, maps, and notifications to the wearer's field of view. And then there's the car. Apple has a team working on car interiors, exteriors, batteries, and other technology. But don't expect the Tesla rival for at least another 5 years. I'm Mark Gurman. This is Power Up.
Bloomberg's Mark Gurman reporting there. And a reminder, we will be covering special coverage of the GameStop hearing tomorrow, 12 p.m. Eastern Time. Included on the witness list, Robinhood CEO Vlad Tenev, Citadel CEO Ken Griffin, and Reddit CEO Steve Huffman. We're just getting in Steve Huffman's testimony. He is expected to say, and I'm quoting here, "We have since analyzed the activity in Wall Street bets to determine whether bots, foreign agents, or other bad actors played a significant role. They have not. In every metric that we checked, the activity in Wall Street bets was well within normal parameters, and its moderation tools were working as expected." He goes on to call Wall Street bets a real community in his testimony. Again, our coverage starts at the beginning of the hearing, beginning at noon Eastern Time. And that does it for this edition of Bloomberg Technology. I'm Emily Chang in San Francisco. This is Bloomberg.